Good day and welcome to another one of our Ransford's weekly wraps. As always, what we'll do is we'll go over what happened in the last week or so and discuss what that means for you and your investments going forward. Today we'll have three main topics to discuss. One is US inflation, the other is UK inflation, and finally we're going to get into a little in-depth look at what happened to FTX and what it means for you and your investments going forward. Okay, so let's just start off with the US inflation number. We had producer price inflation coming out of the US and it came in a lot lower than expected. One interesting factor around it as well was the fact that they saw the services sector also having lower than expected inflation. Now, why is that important? Well, I've said this before, and you've got to understand, it's worth repeating, that inflation of commodities, inflation of goods is not really a big deal. Why? Because prices go up and down. The price of a car can go up and down, the price of gold can go up and down, the price of oil can go up and down. Inflation of wages really is a big deal. Firstly, wages don't tend to go down. They go up and they're going to stay up. So for instance, the price of oil can go from 100 to 130 and back to 100 again, no problem. If your basically wages went from 100,000 to 130,000, there's no way you can accept it, 130,000 back to 100,000 movement. That just does not happen, number one. Number two, if you had last year an improvement in your wages from 100,000 to 130,000, you're not going to be willing to stay at 130,000 this year. So you're going to expect another increase for the next year. So when wages basically start to experience inflation, firstly, they become sticky, and secondly, they build up momentum. So the fact that we are seeing services inflation not as high as had been anticipated seems to indicate that wage inflation, because services is basically human labor, is not as high as, the inflation there is not as high as had been feared. That means people are still not at a point at which they are actually trying to, price in the high inflation they're seeing in the economy into their wages. And that gives the Federal Reserve a bit more leeway in which to basically pull back inflation. If they can get, normal inflation back to non-services, non-wage inflation back, to under 5%, it's quite frankly, it'll be quite a good chance of sticking because, like I said, there's no momentum on that inflation. The momentum really comes through on wage inflation, which we have not seen yet come through. The next thing we have to see is the UK PPI as an inflation number came in just over 11%, higher than expected, and seems to be rising. Now, we've talked about this in the past, but this winter is going to be a really key winter for what happens in Europe. And of course, the UK is part of Europe as well. Why? Because these places have pumped up their gas reserves to the maximum, the energy reserves to the maximum, but it may not be enough. They were used to a steady flow. Now they're going to have to live off the stock that they've received, okay, and are storing away. The flow from Russia is cut off. And so we are likely to see quite a bit of uncertainty over the winter, especially if we do find a colder than expected winter coming through. Right now, winter has been relatively, mild in the UK, in Europe. We're talking about temperatures that are coming down, but not dramatically. But should, we get bad numbers in like December, January, February, that might cause a bit of trouble. Inflation in the UK is partly driven by this massive increase we are seeing in energy prices. And if we see energy prices start to rise going into winter, that's obviously going to cause some trouble going forward. Now, Rishi Sunak, the new Prime Minister, has come out with what seems to be a more aggressive plan around, trying to fight inflation and trying to get the UK economy back on track and the UK government spending back on track. He's basically proposing higher taxes, lower spending, reducing the deficit and so on. Now, it's all good and fine. But one of the things that they are promising to do is trying to protect people from these high energy prices. If we see energy prices go up, if we see inflation rise, there's going to be a limit to how much the UK government is able to basically step in and be austere. Austerity is one thing, a balanced budget is one thing. Trying to protect people from freezing, is a totally different situation. So it remains to be seen what's going to be available there. But at the moment, the UK inflation number is higher than expected and rising. The estimates that we could see UK inflation by early next year, close to 15, maybe even above that percent. That's a gigantic number, okay? And so finally, into our deep dive of the week, we're going to talk about FTX. That is the second largest crypto platform that just went bankrupt. Now, why is this important and what does it mean for you? Firstly, it's important as a moral lesson. Why? FTX was situated in the Bahamas. It's run by a bunch of 20-somethings. I think Sam Bankman-Fried just turned 30. SBF is his name, is abbreviated to. And he had this bunch of kids running this multi-tens of billions of dollar corporation out of basically the Bahamas with very little oversight either from investors or from regulators, engaging in what is in all likelihood, fraud. If not fraud, then the greatest level of incompetence that has ever been seen by anybody ever, quite frankly. And this has lost many, many retail investors, tens of billions of dollars in total losses. The moral to be learned from here is this. We had some of the smartest investors in the world in this particular investment. We had Tiger Capital. We had, some of the biggest Silicon Valley kind of guys in there. We had some of the biggest institutional investors in the US and in Europe and stuff, having some money in this place. These were the smart guys, okay? They didn't catch this thing. What it proves is that, yes, you may be a smart investor. You may be clever about what you're putting your money into, and you may check behind the scenes to some extent who you're putting your money with. But if you're in a jurisdiction where the oversight by government, by official agencies isn't high enough, you're still vulnerable, okay? You can't be smart enough as a retail investor to vet a company to overcome it being in a jurisdiction where the oversight by the government isn't high enough. If you want to, as a retail investor, go to some tropical island, I mean, these guys were based in Bahamas, but there's lots of schemes out there around the world in some small island, in some small country, where you can come in, you can put your money down, you can evade, to use a polite term, of taxes, evade scrutiny by government, and so on. Understand that yes, you may have less scrutiny by government, but they have less scrutiny by government as well, the people that you put your money with. And yes, you may get out fine if there's trouble, but quite frankly, without that government scrutiny, you are going to be more vulnerable, because most government scrutiny outside the stuff around taxation is about protecting you, the retail investor, from the dangers of predation by these smart companies. The companies will always have more information than you because it's their information. They will always know what their books look like better than you, their audit looks like better than you, what they're doing better than you, because it's all their information. The only way for you to access information is for them to give it to you, or for them to be forced to release it by a government, by an overarching regulatory authority. There is no way for you in a unregulated environment to ever have the ability to really hold these companies to account. So when it comes to investing, okay, the retail investor is far, far better off in a highly regulated environment with high levels of bureaucracy and high levels of red tape than in another environment with much lower levels of bureaucracy and red tape and so on. Because yes, the bureaucracy, red tape, and regulations affect you, but it also protects you. Just like speeding laws affect you, but they also protect you. And in this environment, we are the kind of pedestrians out there. We are the weaklings out there. The big institutions are the 18-wheelers, the trucks, the cars, and so on. Their power is far larger than yours. If there's no regulation, you are going to be harmed much more by a problem than they are. Okay, so when it comes to something like FTX and other institutions like this here, my advice is always go for the most regulated environment that you can. Now, as a South African investor, you have a few options in the world. Your options are Europe, Asia, North America. There's lots of places that are highly regulated. The best place for you is likely to be Europe, and it's for the following reason. Firstly, this wasn't the case a few years ago, but I'm more and more concerned about it. It's geopolitical risk. The world's more dangerous now than it was 5-10 years ago. The Russia-Ukraine situation is just one thing. There's the possible China-Taiwan situation. There is, India, Pakistan. There is, a variety of things around the world that are hotspots that might affect you as an investor if you are not only the country that's been affected, but also in any surrounding country. Now, if we look at, for instance, the Russia-Ukraine war, Poland is totally protected. Why? Because it's part of a larger institution, NATO. Most of the countries bordering the Ukraine are totally, protected by it. Why? Because they're part of a large institution. If Poland was not part of NATO, if Poland was on its own as a little country next to the Ukraine, it'll be much more vulnerable to what happens in the Ukraine. Now, if you look at Asia, most of those places are actually, far more vulnerable. Mauritius, Singapore, Taiwan. They have really good regulations. They have, good history, blah, blah, blah. But in terms of protection against the geopolitical risk, not really. Who's protecting Mauritius? Who's going to protect Singapore? Yes, there is that possibility the U.S. might protect Taiwan, but there's not a guarantee. There's promises, but there's no guarantee from the U.S. There's no treaty, quite frankly, to protect them no matter what. So, Asia, to a large extent, just because of the geopolitical risk at the moment, is kind of, I think, stay away from. Uh, Countries that are large enough in the area, places like Japan, to say, okay, they wouldn't be affected by this as much. The language and other barriers make it difficult to invest in there. North America, I'd say scratch out as well, because the Americans, the US basically has a very complicated, very weird tax system that doesn't mesh well with anywhere else in the world. If you're not going to become a US citizen and live in that country, it's not really worth the hassle of having funds and assets basically governed by a US linked authority. So forget North America. So that leaves Europe. In Europe, Northern Europe is probably better than Southern, because the Northern European countries generally have better fiscal conditions. They have a better balance of payments. They have better protection and better stability. You had some really, really great levels of uncertainty in places like, for instance, Greece and Spain and Portugal. Recently Cyprus. They're much less, I would think, stable as jurisdictions than places like, for instance, Denmark and, say, Switzerland. Okay, so my recommendation to you guys is to look at custody, look at where your money is being based. Don't think that if you go to, like I said, some nice little tropical place that has low levels of regulation, that you are going to benefit from that. No, you are not strong enough. You're not powerful enough institutionally to take true advantage of what's happening there. Okay, you are more likely to be taken advantage of than to get an advantage by going to these low regulatory environments. As a retail investor, you're far better off going to the high regulatory environments. And in a process of elimination, the high regulatory environments that I recommend for you guys are in Northern Europe, okay? Because that's the safest place in the world to be, given what's available to you as a South African investor, okay? Now, that is wrap for the week, and hopefully you guys enjoy that, and I'll look forward to speaking to you guys again next week. Cheers.